Kia ora koutou, welcome to Shared Lunch. I'm Garth Bray. Well, the Reserve Bank's made another call on the official cash rate, and that has implications for our whole economy. Will it provide the stimulus that we need? One of the earliest voices calling for stimulus to get things running again, Kiwibank's Chief Economist, Jarrod Kerr.
We're saying, just put your foot on the accelerator, not hard, just get the economy going. Smash the perception that we've got too much debt as a government. I don't think we do. I don't think we do at all.
He takes us through why he sees the need for this right now.
We haven't invested in ourselves. If you think about the long game, spending more on infrastructure today will give you a harder, faster, stronger economy. Oh, and that's a larger tax base tomorrow.
But first, some important information you should always consider when investing.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Here is a man who thinks that stimulus might just be the answer. Would that be fair to say?
Oh, absolutely. I think it's pretty clear that the economy needs, a little bit of encouragement right now, and we're just not getting it. I think interest rates haven't reached that level. Well, I know they haven't reached that level where investors and businesses feel like they want to take a punt on something.
We've launched straight into it without even saying welcome to Sharesies and thanks for being here, Jarrod.
That's all right.
No mucking around and straight into it. So what is it that makes you think that there needs to be a stimulatory track to monetary policy? And for someone who just wants to speak in single syllables, what does that even mean?
It means that interest rates have not yet reached a level that are exciting people or that are encouraging businesses. So we have this theoretical rate called the neutral rate, right? And we think it's around 3. It's a Goldilocks rate. It's not too hot, it's not too cold, right? We know that the cash rate at 5.5% last year was way too restrictive, right? And that drove the economy into a recession. They've cut the cash rate from 5.5 to 3, and we haven't seen that, inspire anyone. What it has done is it's given relief to people, but it hasn't really, triggered them. We think it needs to go down to at least 2.5, and just to give people that incentive.
So much to unpack in there. I guess some would say you head for the neutral rate will get you to the place where it's up to you to make the decisions, to take the risks, all that sort of stuff. Why are we relying on a central bank and a monetary policy to try and fire things up if they aren't already ready to go?
Yeah, well, that's their job, right? So let's go through it. They overstimulated during COVID. They purchased a lot of government bonds, so they printed a lot of cash. Central banks around the world printed trillions of dollars, and we came out of it firing on all cylinders, right? Because governments were spending, central banks were printing cash. Next minute, we had an inflation rate of over 7%. Okay, they overdid it. They had to get that back down to 2. So they lifted interest rates from near zero settings to quite aggressively high settings. And that really hurt households and businesses, drove us back into recession. And we haven't gotten out of that recession yet. We're still crawling out of this hole that the central bank poured us into last year. And I think, just using the car, example, you've had your foot heavy on the brake, you've taken it off, you've put the car in neutral, it's just idling. We're saying, just put your foot on the accelerator, not hard, just get the economy going.
Is that a consensus view? Are you on the outer on that?
We were. We were calling this a year and a half ago. We were well, outside of the consensus calling for a 2.5% cash rate. Now there are a few more. Most economists are around that sort of 2.75, 3 level. So we're only arguing over 50 basis points.
There was a sort of a split decision back in May, although there was a consensus around holding steady in Wellington on the most recent one. You had, I think, in the US, the first time in about 30-something years that 2 governors said, we want to express our dissent with the rest of what you guys are coming up with. The Bank of England, I'm just telling this for the people that haven't been paying attention. You know this. Is it getting harder to work out what's going on in that room, what they're deciding, and how they'll pick? Is this just part of the cycle?
Yeah, I think it does get a little harder when you're towards the end, for starters. So from the Reserve Bank of New Zealand's point of view, they've gone from 5.5 to 3. There's not a lot left, and they're just kind of feeling their way down to the bottom, and the bottom's near, right? You could say the same thing for other central banks around the world, but let's not forget we've had this tariff war of sorts over this year that's really thrown a lot of things up in the air. We know it's inflationary for the United States, so that's why you're getting that sort of mixed feel from the Fed governors, and we think it's deflationary for us, but it's yet to feed through. So, there's a lot of balls in the air, there's a lot of volatility, there's a lot of questions that need to be answered.
And we've got another complication because we've got an acting governor at the moment and possibly a permanent replacement coming through sometime soon. Does that mean that the bank's going to be saying, the Monetary Policy Committee are going to be saying, we'll leave it to the new boss?
No, I don't think so. They've got a job to do. They know what the job is. It is a committee now rather than a sole decision maker like it used to be. So you've spread that a little bit. And Christian knows what he's doing. Christian's been around a long time.
This is Christian Hawkesby.
Christian Hawkesby, who's acting governor at the moment. He's been at the Reserve Bank, I'm not sure, about 6 or 7 years himself. He was working for Harbour Asset Management, so he knows the markets very well. And he also worked at the Bank of England prior to that. So talk about credentials. He knows what he's doing. So there's no excuse, we better wait for the next governor to come in. No, they just need to do what they need to do.
A lot of people are saying it's not so much about whatever the decision has been, it's more about where we're headed from here.
Absolutely.
What the shape of that curve looks like. Yeah. When we're going to see rates start to rise again, where that bottom is. Do you have strong views there?
Yeah, so like I said, we're at 2.5. Market's kind of around 275-ish. So we're not arguing over a big difference, but from our point of view, that extra 25 is meaningful. And it would just get mortgage rates, that little bit lower than where they are today. Whereas if we stop at 275 or 3, then mortgage rate, that's them done. That's the bottom. And I just don't think that's stimulatory enough.
All right, say we do get to 2.75 or even 2.5. What does that mean for a mortgage customer?
So very simply, the cash rate is what the banks deal with the central bank, right? The central bank is the banker of the bank. So we're dealing at say 3%, but that's not where we fund ourselves at. Like we will offer a term deposit rate. I think we've got one out there at like 4.1 at the moment. So that's quite a bit higher than the cash rate. That's because we're trying to get money, in the door, and then we lend it out, right? And then we're charging 5% on a mortgage rate or above. So you get all these rates, but the cash rate influences everything above it. So you drop that cash rate from 5.5 to 3, and what you've seen is mortgage rates go from 7.5 to 5. So roughly lockstep. Doesn't happen precisely, but it has over the year. We've seen that whole lot being passed on. What does another 50 basis points mean? Well, those 5% rates or slightly above go into the mid 4s, and you get that little bit of extra bang for buck, and delivering that extra 50 basis points in the cash rate. Term deposit rates fall as well. So there's a lot of savers out there that go, I didn't realise. It's like, well, actually, we've been talking about rate cuts for over a year. You could have been preparing yourself on the way down. We always talk about the household with debt. Your mortgage rate's falling. Actually, if you're retirement, if you're in retirement and you're getting less on your nest egg,
and that fixed income suddenly isn't quite so attractive, you need to look at diversification to kind of cover yourself.
Right. This is precisely. So putting the cash rate at 5.5, you're trying to attract savings, right? Dropping it down, you're trying to get savings to go out into more riskier assets. You want to get them out into, either simply buying shares or getting businesses to put money out the door to buy, investment like tractors and stuff.
I mean, if we look around, there's been a lot of worry about debt. I mean, there's been a lot of talk about debt this week. I think one of the major papers saying, look, we're on track to $1 trillion worth of combined public and private. A big number. Does a big number like that give you any pause, any concern?
Well, the big number, shows a lot of private debt, a lot of household debt, right? As a percentage of income, it's gone sideways for a while, but it's at a very high level, comparatively speaking. So we got a lot of debt on the private side, but we don't have a lot of public debt. And this is something that we need to smash wide open in the New Zealand public. You're
not talking about smashing it down, you're talking about smashing it up.
I absolutely, no, smash the perception that we've got too much debt as a government. I don't think we do. I don't think we do at all. I think we can take on a lot more debt to tackle the infrastructure problems that we've got. I would argue that we have not only disappointed the New Zealand public, but actually haven't fulfilled what we should have done as a government over the last 30 years. We have not kept up our infrastructure spending with our population, right? That's just a simple message to everyone. It takes us 40 minutes to drive 10 Ks in Auckland, right? Wellington looks more like Venice than it does anything else with all the water running down the streets. I mean, the burst pipes. There's so many examples. And then the good examples, Christchurch. Look what happens when you build back beautifully. It's a cool city. People are a lot more upbeat down there. And it's because, they've got the infrastructure.
Is it not just because the regional economy is strong and you've got a lot of farming and so on happening there and that's supporting it, whereas other places, you're not seeing that?
Why is Waikato and other areas not as upbeat as Christchurch, right? They've got that farming base. That's that external sector that's doing well. You're getting high dairy prices, high meat prices, tourism's bouncing back. But the South Island seems to be a lot more upbeat than the north, and there's something going on there.
If you look at farming and agriculture in general, I think the total agricultural debt is down at the moment. So At a time where those prices are great, where farmers are making bank, they're choosing to retire debt rather than to invest. What does that say?
Yeah, and I think they've been asked to do that too because they'd taken on a little bit too much. So I think a couple of the major banks have been asking, actually, maybe you should repay a little bit, which is prudent. But what we're seeing and is that farmers are spending on the farm. So they may have sort of run down their maintenance a bit. Now they're ramping it back up to where it should be, spending more on animal welfare, spending more on the farm, but not past the farm gate. So they might be buying a tractor, for example, but they're not buying it used. They might be, doing their fences, but they're not going on a holiday. And I think that just shows you how cautious they are. Even though things are pretty good and they're getting a very high payout, they're spending on the farm. They're not spending outside of it.
And then if we're looking at business, I think the business lending as well, business borrowing in the year to May was sort of up just a fraction, not even a full percentage point. Again, that's... You say because it's not stimulatory enough, or companies just don't see the reward justifying the risk?
Same thing.
Even with the investment boost, what happened to the investment boost so you could write off a larger portion of a capital purchase? We're not seeing that play through?
No, we're not. And that just proves the fact that we're still in this recession, I believe. So we recorded quite a sharp contraction last year, and we're going sideways. And it looks like in the current quarter we're in now, we might record another contraction. So it's pretty weak out there. Businesses aren't taking on debt because they are cautious. They're worried about, what do all this tariffs mean for us? The New Zealand household's not spending yet. You're very cautious as a business right now, and we're noticing that in our lending. That investment boost helps, but it's not driving you to make the decision, and businesses aren't making that decision at the moment. You ask them, are you investing? And you're getting quite a mixed response. Most of them are saying no. And you ask them, are you hiring people? And again, most of them will say, I'm actually going through a bit of a restructure still. So until that turns and we see it going positive, and there's signs that it is, they're just sidelined.
But there's signs there isn't. I mean, the Performance of Services Index, I think, came out this week, and it was the 20th month in a row that the employment
it was less
section
negative,
of that,
but negative.
Yeah, but the employment
That's right.
part of that's been in the dumpster for 20 months now.
20 months.
Yeah.
Yep.
That tells you, I suppose, that if you're a services business, which is sort of, what, 2/3 of the economy, 3/4 of the economy?
2/3, yeah.
Yeah, that's a lot of businesses out there that are wary about hiring.
Yeah.
Where's that landing? Who's getting hit by that?
Oh, well, it depends what industry you're looking at. Like I said, the agriculture side's doing well, and they're finding the workers that they need. So there's definitely not a shortage of workers anymore that we had, just a couple of years ago. There's actually a bit of an oversupply. And then you go across, like you say, most of the services side, they're not hiring. I gave a few presentations to quite large groups recently. One was in Wellington, and there were about 200 people in the crowd. And I said, are you investing? Are you hiring? And about 8 people put their hands up. I counted them, 8. And then I went to Christchurch, and at least a third, maybe 40% put their hands up. So still less than 50, but geez, there's a massive difference between Wellington and Christchurch. And Auckland's kind of in the middle, about 20% people put their hand up. So when I do that and I sort of gauge a crowd, I'll sort of walk out going, okay, that's, depending on where you are, it's worse, but overall it's still quite weak, even in the hotspots like Christchurch.
But then if there's that much gloom, is cutting interest rates really going to provide people with the stimulus, because they're still going to be nervous about taking action, right?
Better than doing nothing. It's better than leaving the cash rate restrictive or neutral, so you're effectively not doing anything.
We talked about tariffs there, and I just want to ask you, have we overbaked the concern around the trade war and the tariffs and that kind of thing? With US tariffs, I think US exports are about 2% of our GDP. There's plenty of other places we're doing business, right?
And talking to exporters, they'll say, the US is actually one of the most profitable markets that we export into, so they can actually wear a bit of that tariff themselves. Kiwi dollars come down a little bit as well. I hope it goes a little bit further. And again, that helps. It helps from the US side. There's fewer US dollars they need to buy Kiwi. So we definitely got panicked at the start when Trump came out with these massive numbers. But we all turned to each other and said, that's a negotiating tactic. He's going to water it down. He watered it down a lot more than what we thought. And I think if we look at the impact, most of it's going to be on the US consumer. I would love New Zealand to get a 10% tariff rather than a 15%. But, it's not going to end the New Zealand story. They are a very, very big export destination for us, but we export meat. And they're not going to stop eating burgers, and they'll wash it down with a Kiwi wine as well. So I'm not too worried about that. To be fair, we thought, what does it mean for the rest of the world? It's a world that's slower and trading less with each other, but not to the extent we were worried about in April. So there's a slowdown there. China is already diverting some of their exports into Europe and elsewhere. I think that's a bit deflationary, that slower growth, that diversion of trade. So from our perspective, we actually think it's deflationary. It's going to add to inflation dropping below 2%.
I guess people were worried that, like you said, it was going to be a widespread tit for tat kind of reciprocal
Absolutely.
tariff war. People haven't sort of done the tat, right?
Yeah. Typical analysts like ourselves, you go down these rabbit holes. You go, well, this is what we've seen. It could spiral off over here, or it could calm right down. And we were worried more about the spiraling into uncharted territory. Whereas it just at the end of the day, the tariffs are a tax take. That's mostly what it is. It's let's just take 10-15%. And when you model what the impacts of tariffs are going to be, 10 to 15%, you actually generate quite a bit of revenue for the government. 30, 40, 50% tariffs don't generate much revenue.
Because it smothers the trade.
Exactly. Right. People divert their trade elsewhere. It actually changes behaviour. If you're a government and you want to generate revenue, you don't want to change behaviour. And that's where we've ended up on most of these tariffs. So I'm looking at it and going, okay, he's done a whole lot of negotiating. He's done a whole lot of things behind the scenes, but he's kind of He's just wanted to generate some revenue. I mean, he's got to pay for the tax cuts that he brought in his first term.
Someone has to. I mean, we worry about this, I suppose, as a nation, going back to what you said about our debt levels and whether we've serviced the needs of our society or our economy. There's a lot of pressure on governments to return to surplus quickly, and a lot of scolding gets applied to whether it's National or Labor holding the Treasury benches, about that return. I think at the moment, even Fitch, one of the ratings agencies, when it reconfirmed that New Zealand's got I think it's a AA plus
under them, I think,
Great credit score to have. Go out
fantastic.
and borrow, but please don't do any borrowing. It's sort of almost the thing. It's nice, but don't take it for a drive. Because they're saying you keep pushing down the road the point at which you're returning to surplus. And they're saying that's a worry. I mean, you've worked in international money markets and, you've got to heed those people, haven't you?
Yeah. Oh, absolutely. It's a big deal, and New Zealand's got a AAA rating under Moody's, right? That's as high as it gets. I kind of wish we didn't have that, to be fair, and it was AA, and that was all we were going for. But there's an OPEX versus CAPEX thing here. So there's running a deficit because you're spending too much and you're not collecting enough revenue, and you need to think about your taxes, you need to think about your spending, and this government's doing that. But then there's if we went out to the market and issued an infrastructure bond and said, hey, we want $50 billion and we're going to issue that and it's going to go towards infrastructure, then most people will turn around and go, okay, fine.
New Zealand, good risk. We'll put our money there.
Great
People
risk.
in Singapore and Japan.
It's going into building assets.
People here, hopefully.
There's going to be a return on it, hopefully. It might be a toll road, it might be whatever. Get the private people involved. Do what you need to do to build the infrastructure. I don't think the rating agencies or investors would even blink. It's like, you're finally playing catch up for 30 years of not doing enough. Cutting taxes, spending more on beneficiaries or whatever, that's what gets the rating agents more concerned. Building a bridge, building a road or whatever, that's building in the productivity of your economy. And we sit here looking at these really disappointing productivity numbers for New Zealand and elsewhere, but for New Zealand in particular. And we just go, you know what? A lot of that's just a lack of infrastructure. We haven't invested in ourselves. And governments need to realise that if you think about the long game, and unfortunately they're only thinking about 3-year games, if you think about the long game, spending more on infrastructure today will give you a harder, faster, stronger economy. Oh, and that's a larger tax base tomorrow. We don't seem to be able to think in 10, 20, 50-year chunks. We're only thinking in 3-yearly chunks. Look at this government now. They haven't been in there that long. They're kind of halfway through, and they're already looking to next year, going, "Geez, we've got to deliver in order to get voted back in." It's not enough time. Not enough time for either side of government.
Well, we might get to decide on a 4-year term at the next election anyway.
Yeah, but it's like you want to give them a 4-year term with the expectation of getting 2, almost like the US. You kind of expect them to get 2 terms, and you've got them in there for a chunk of time. And you can kind of get stuff done over that time frame, but 3 yearly, and then the complications of coalitions. It's just, it really inhibits their ability to get stuff done.
Well, it provides some interesting ideas. I don't know. Yeah, possibly. But I mean, you get ideas, you get minority parties like ACT or the Greens that are lobbing in sort of slightly saltier suggestions, like we should run hard on that deficit, or we should, really pull the chocks out and go for an extremely stimulatory position. And that what function does that have?
Well, I think you get these two centralist parties, and then you get some on either side recommending the more extreme. And a lot of voters will look at the two central parties and go, you know what, they're not really either side's not really giving me something, so I'll go to the ones that are a bit more extreme, and we see that. I just wish we would have a better debate about the type of debt that we could issue and what that money would be used for. If we went out to the investment community and said, give us $50 billion, we want to do these projects over the next 10 years. Will you fund us? Absolutely they would. Absolutely. They're looking for 10, 20, 30-year debt. ACC is a great example, insurance company. They want long-term bonds to invest into. So they would be, itching to buy 20, 30-year bonds.
We're the world champions of comparing ourselves. Straight to the kicker. Who's doing it better than us right now?
Yeah, I think Australia is definitely outperforming us at the moment, and that's because they are. Their central bank didn't go as hard on the rate hikes, so therefore the Aussie economy didn't slow down as much. And they didn't record a technical recession. They've got a recession in per capita terms, but it's quite shallow compared to ours. So we just look at the Aussie economy and go, oh man, it's just growing nicer than ours. The labour market's tighter, wage growth is more, they're just more buoyant than we are at the moment. And that's why we've seen a net 43,000 Kiwis leave in the last year. So we've seen 70-odd thousand Kiwis leave and then some coming back, but that net 43 is huge.
How much of that is off savings and just a stronger, a better national superannuation structure so that people are putting more money aside?
Oh, I mean, that's been a strength of Australia for a while now. They've got, I think, the 5th largest sovereign wealth fund on the planet for an economy which is less than 2% of the global economy, to have that sort of savings there. And you know what? They don't think they've got enough. They are still increasing their compulsory. I think it's gone up to 12% now. It was 9% when I was working there. I tell you what, working 13 and a half years in Australia, I've actually got this nice little nest egg sitting there that I wouldn't have had otherwise. There's no way I could afford to put 9% away over that entire period, but it's sitting there and it's great. And we're doing it here now, should be compulsory, should be a much higher rate. But, some things Australians just do better than us. One thing they are pretty good at, particularly at the state level, is the big infrastructure stuff. They just seem to get stuff done. And I use Sydney as a classic example where you've got this bridge and it's got heaps of lanes. It's got a train track going both ways, so trains can go across. You can walk down one side of it, you can cycle across the other side of it. And that was built, 50 years ago. That's not enough. Their cities grew, and they've got a tunnel going underneath. Now you've got ferries, you've got plenty of ways to get across to Sydney Harbour, right? Here, you've got a bridge that was built in the 60s, I think.
On the cheap. It
reached capacity 5 years later, so we tacked on some clip-ons and we've done nothing since. I think it just highlights the difference between us. They can deliver these big projects in Australia, and they can think a lot further ahead for some reason, and I just wish we would snap out of it.
Let's look at, we're in the middle of earnings season at the moment. What are the economic themes, the macro themes, the big bits of or clues you're getting about the state of the world and the state of the economy from some of the results that we're starting to see through? We've had I think A2 Milk and a couple of the big gentailers here. Aussie's had some of their resources reports in the last couple of days. Does that help colour your understanding of what we're going through?
Yeah, it does. It does. You get a flavour as to how certain businesses are faring, and does it match the data? Yeah, it kind of does. There's certain external businesses that are exporting stuff. They're doing okay. Tourism related stuff. Some other things are bouncing back, but generally looking across the whole economy, if you actually go beyond the listed companies and you look at, say, corporate tax that the government's collecting, it's very weak, very soft. So it's still better than last year, but not good. And we're still sort of feeling our way out of this recession. Earnings overseas have been okay, but I'm not shooting the lights out.
No. And you've got a lot of IRD-based liquidations. They're really cracking down hard on people.
They have just gone like that. And it's like, we sit there and go, I'm sorry, but that's exactly what you see in a recession. People hold on for as long as they can, And then if you're not recovering quickly, which we're not, then unfortunately a lot of these businesses go bust. And we have seen quite a lift in receiverships, liquidations, all that horrible stuff that we don't want to see. And again, we look at that and say, hey, there's a lot of pain out there. What are we doing as a country? Government's not stimulatory, central bank's not stimulatory. We've been through this huge recession. Where's the helping hand?
You've been quite interested in understanding money and finance and the economy for quite some time. How did that spark start for you?
Yeah, pretty much my whole sort of adult life. Like, it started at school. And like many students, I'm completely useless at English, maths. I was getting like B's and C's and stuff. And then I had this fantastic economics teacher who's now teaching at Westlake Girls, Dan Rennie, and he just brought it to life. He got me reading the monetary policy statements from the Reserve Bank at like the age 13, 14, and I've been my whole life. That's my whole life. I've been reading these monetary policy statements. But my best mate, he went on to be a lawyer, so he was dreaming about being a lawyer. I'm dreaming about being an economist, and we both get together these days and look back and laugh. And we basically have done what we said we were going to do at like age 15.
How do we get people fired up about that, interested in those things? Is it just innate?
Try it out.
Or
try it out. I mean, there's some cool things that I wish were around when I was at school. There's a system or a program called Banker, which is so cool. They get students, really involved in finance and making decisions as if they're adults and running a home, running a business, buying shares, that sort of stuff. And they get them involved in it early. I think, financial literacy is something where I don't think it requires a lot, and I'm glad the government's tackled this and said, we need to do this. Don't think it requires a lot of teaching to give you just a real basic understanding. I'm always saddened when I hear of people being so scared to walk into a bank. Oh, I don't want to talk to them. They're not going to approve my loan. It's like, walk in there, slap it on the desk and say, I want my loan. And if they say no, go to the next one, the bank's there. They want you as a customer. And it's that financial literacy, if you're not there and you're not comfortable in your own understanding, you are going to be nervous walking into a bank, and that shouldn't be the case. If they'd had, proper bit of training on just how to do simple things. And putting money away into a Sharesies account, I think is part of that, right?
Money makes it matter.
Yeah. Don't be scared of it. Just start doing it.
Right. Well, let's see if that attitude will infuse itself out after this podcast, and we'll start to see those green shoots. Jarrod Kerr, thank you very much for your time here. And thanks very much for your attention, for listening in. Whatever you made of that, let us know. Let us know if there's something else that we should be covering here on the Shared Lunch. Ko matu, that's us for now.